A gente está muito feliz de poder reunir vocês e dividir um pouco aí do que a gente veio do que a gente veio experimentando aí, vivenciando nesses últimos meses. A gente fez esse convite em conjunto com os nossos sócios americanos, que é o pessoal do grupo JLP, que estão aqui presentes. Depois a gente vai passar a palavra a eles. E queria, antes de mais nada, dizer que a gente está muito feliz de poder ter feito esse movimento, né, através de um processo aí de capitalização. O Pedro, que foi meu sócio durante, né, ainda é meu sócio há muitos anos e com quem eu trabalho muito bem em conjunto com a JHSF Internacional, aqui representada pelo Zeco. A gente, no mês passado, fez a aquisição de uma plataforma de investimentos global em real estate e focada em ativos líquidos. E a ideia aqui era reunir esse grupo de amigos, gente que a gente valoriza, gente que a gente respeita, para apresentar um pouco sobre o que essa companhia que a gente adquiriu veio fazendo, né, e um pouco do que é o histórico e o que nos levou a fazer esse negócio, e dividir com vocês um pouco de quais são as tendências e quais são as grandes oportunidades que a gente está enxergando nesse momento. Eu vou falar um pouquinho aqui sobre o que nos levou a realizar esse investimento. Depois o Pedro vai comentar um pouco sobre o nosso processo de diligência, e depois o Zeco vai comentar um pouco do porquê que ele e JHSF Internacional resolveram também fazer esse investimento e participar desse processo. Depois a gente vai trazer o time aqui representado pelo Jim, que é uma pessoa que tem, enfim, um histórico enorme de investimentos na área, são quase 40 anos, e que construiu um time espetacular, que a gente tem muita confiança e, enfim, muito sólidos na abordagem de investimentos. E a gente vai falar um pouco sobre o tipo de oportunidades que eles estão vendo aí pelo mundo. Bom, como é que começou essa história? Sendo bastante breve, né? Eu acho que quando começou a pandemia, eu conversando com o Pedro e com o Zeco, a gente tinha alguma clareza de que dentro das diversas classes de ativo globais, a área de real estate ia ser uma daquelas que mais ia sofrer. Naquele momento, um primeiro passo que a gente deu foi procurar uma pessoa que está aqui presente, que é a Ellen Schumann, que foi, no histórico da Tarpon, talvez a investidora mais importante da nossa trajetória, uma pessoa que apostou na gente desde o começo, e ela tinha sido diretora de real estate do endowment da Universidade de Yale e conhecia muito do setor, e ela foi uma das primeiras ligações que a gente fez naquele momento. E a provocação que a gente fez naquela altura foi: olha, se você enxergar algo que junte real estate com a nossa capacidade, né, o nosso histórico de empreendedores na área de serviços financeiros, a gente gostaria muito de gastar um pouco de tempo, né, e investigar junto contigo. Em paralelo, o Pedro está no conselho da Universidade de Chicago, né, da Business School, e ele tem um colega no conselho, que é uma pessoa que talvez alguns de vocês conheçam, que é o Thomas McDonald, dono da Jaguar Equity Partners, e ele fez essa mesma provocação ao Thomas, e o que acabou acontecendo naquele momento foi uma convergência que acabou sendo para nós bastante feliz, né? O Thomas era um acionista de referência dentro da Jaguar Listed Property, que é essa empresa hoje rebatizada como JLP, e o Thomas disse ao Pedro que eles estavam querendo focar somente em investimentos de private equity e que eventualmente avaliariam uma saída do negócio. E foi naquele momento que a gente começou a gastar um pouco mais de tempo, né, para compreender um pouco da oportunidade, né, da profundidade da classe de ativo. Foi aí que a gente voltou a conversar com a própria Ellen, que conhecia, né, obviamente, a JLP e a Jaguar de muitos anos, e especificamente o Jim, e construiu essa ponte, né, de referências aí muito positivas e que fizeram com que a gente conseguisse construir uma uma transação que fosse uma transação de aquisição de controle dessa gestora. Por que a gente, no final do dia, acabou fazendo, né, esse negócio? Acho que, primeiro, tendo sido, acho que a gente teve uma boa história na Tarpon, né, onde a gente tentou fazer as coisas de uma forma diferente e olhando para oportunidades no Brasil como fora do Brasil, e aqui, e a gente entende que esse negócio é um negócio, né, de gente, de talento, e aqui a gente enxergou um time muito bom, que trabalha junto há muito tempo, com uma base de clientes institucionais de muita qualidade. São poucos clientes, mas são clientes que estão com eles há 15 anos, na média, com uma abordagem muito parecida com o que a gente também estava acostumado a conviver, que é compreensão profunda sobre cada um dos ativos, uma visão muitas vezes saindo um pouco do que é o senso comum, compreensão específica sobre os trends da indústria, e à medida em que a gente foi gastando mais tempo, a gente foi ficando mais satisfeito, e no final do dia o que a gente enxergou aqui é que tinha uma oportunidade da gente empreender em algo que a gente, né, dentro de um modelo de negócio que a gente conhecia, e fora do Brasil, que também acho que como brasileiro e quem já, enfim, rodou muito lá fora, e a gente conseguiu trazer capital de talvez os investidores mais sofisticados do mundo, a gente acha que tem muito talento na indústria de serviços financeiros no Brasil, e a gente achou que a gente poderia, aliado com esse time, ajudar essa companhia a se tornar aí um player cada vez mais relevante dentro dessa classe de ativo que tem muita profundidade, tem muita volatilidade, e talvez no melhor momento de entry point aí desde a crise financeira lá de 2008. Então, foi motivados por isso que a gente resolveu avançar e fazer esse negócio. E aqui o que a gente se propôs a fazer no dia de hoje foi convidar os nossos amigos brasileiros para que conhecessem e para que, enfim, pudessem compreender um pouco mais sobre a estrutura da classe de ativos, quais são os tipos de oportunidades. O que eu posso adiantar e dizer, e já convidando o Pedro aqui a me complementar, é que a gente é uma classe de ativo com um grau de profundidade e, ao mesmo tempo, de disparidade gigantesca. E é uma coisa que a gente, a gente não estava muito familiarizado, confesso, quando a gente começou a olhar esse negócio, e conforme a gente vai se aprofundando, a gente também enxerga que tem um caminho enorme para fazer gestão ativa, pensar em outras oportunidades de expansão e crescimento de plataforma de produtos. Então, eu diria que a gente está muito animado e entusiasmado com esse passo, e, mais importante, muito feliz com a sociedade que a gente constituiu com os nossos sócios americanos, e também com outro componente que eu gostaria de dividir, que também é uma ponte importante com o mercado de Singapura. Nós temos 2 sócios em Singapura, que a primeira família Cheng, que são, enfim, ligados, né, o chairman da Temasek, o Kelvin Cheng, que é o filho dele, é nosso companheiro no board, e, enfim, isso traz uma profundidade, uma presença no mercado asiático que é super importante, e também o grupo Hua Hong, que é um grupo com um histórico muito forte em investimentos de real estate na Ásia e na Europa. Então, dessa forma, a gente acabou combinando, né, uma expertise de time norte-americano, europeu e asiático, com uma base de acionistas, né, e de reforço institucional vindo principalmente do Brasil e de Singapura. Bom, do lado de qualidade do negócio, né, e do porquê a gente fez isso, eu acho que a gente ficou bastante tranquilo, né, quando a gente olha para uma gestora, mas eu queria pedir aqui, convidar o Pedro para falar um pouco sobre o que a gente viu do lado de histórico, né, de filosofia de investimento, de histórico de performance, de abordagem, porque eu acho que no final do dia esse foi o principal fator que nos atraiu aí até a realizar esse investimento. Mais uma vez, aí agradeço a presença de todos. Super obrigado mesmo.
Boa noite a todos. Em primeiro lugar, muito obrigado por estar prestigiando aí o nosso evento aí como o Edu falou, de poder anunciar aí o resultado de alguns meses de trabalho conjunto meu, do Zeco, do Edu, e agora de todo esse grupo que está aqui com a gente na figura do Jim, que é o CEO, o CIO e o fundador da JLP. Eu diria que foi um processo de aprendizado muito bacana, né? em que a gente se apoiou, obviamente, um pouco, como o Edu falou, na nossa experiência como gestores de investimento, longevos aqui no Brasil, mais de 20 anos aí fazendo o trabalho de gestão de recursos, e poder encontrar no momento aí de oportunidade dessa pandemia e numa classe de ativo muito interessante, que é o real estate global, uma oportunidade de se associar ao time que a gente quer apresentar hoje. Uma vez colocado o desafio, eu fui responsável a entender, obviamente, aquilo que é o primeiro prisma de avaliação de qualquer time, que é a sua capacidade de gerar retornos consistentes ao longo do tempo. O Jim, como a gente sabe, é alguém que tem mais de 20 anos no setor, junto com um time que acompanha ele há décadas, e eu fiz um pouco, às vezes, aqui do nosso analista, entre eu, o Edu e o Zeco, de poder entender realmente da onde vinha essa performance, que parecia, desde o começo, muito consistente. Testamos essa geração de alfa ou de valor acima dos benchmarks contra todo tipo de fator regional. Vimos que, enfim, o time global foi capaz de performar acima dos benchmarks em cada uma das regiões de atuação, a Ásia, o mercado americano, o mercado europeu, mercados emergentes. O time tem capacidade, conhece bastante aqui de alguns nomes no Brasil também, na América Latina. A gente testou muito também da performance contra setores. Lembrar que essa classe de real estate hoje é uma classe muito diversa. Só no mundo dos REITs nós temos aí pelo menos 17 subsetores, sejam residencial, apartamentos, escritórios, saúde, torres de celular, data centers, e a gente viu um time capaz de cobrir todos esses setores de forma bastante relevante. Analisamos o track record de 3 anos contra também alguns fatores, né, mais quantitativos, valor, momento e tudo mais, e a gente ficou muito confortável em encontrar um time que a gente pudesse investir o nosso tempo, o nosso recurso e também apresentar para vocês na noite de hoje. Claramente, eu e o Edu, apesar de termos aí um histórico bastante longo na gestão de recursos, faltava para a gente um pouco o conhecimento específico da classe de ativo, do real estate. Faltava também, e a gente procurou bastante, se apoiar em empresários e amigos que têm uma vivência global, e aí ocorreu para a gente que o Zeco, né, liderando já há algum tempo a JHSF Internacional, com alguns investimentos assim bem relevantes no mercado americano, por exemplo, seria um sócio aí e um telefonema de primeira hora para dar. Para nossa feliz surpresa, ele se motivou muito com essa história, abraçou então o nosso consórcio aí e liderou muito dessa discussão também com o time. Uma feliz coincidência, o Zeco também conhecia bastante o time, que chegou a ter e olhar para a JHSF enquanto investidor. Vou passar a palavra para o Zeco aqui, que pode contar um pouco da perspectiva dele também.
Legal, boa noite a todos. Obrigado, Pedro, pela introdução e obrigado também aos amigos por estarem aqui com a gente. Primeiro, queria falar que para mim foi um prazer entrar aqui no grupo, convidado pelo Pedro e pelo Edu, dizer que não só somos amigos, né, de muito tempo, mas também tínhamos já alguns negócios em comuns feitos. Então, eu me senti muito à vontade com o Edu e com o Pedro para estar entrando e analisando essa oportunidade junto. Falar um pouquinho do histórico da JHSF Internacional. Essa empresa foi um spin-off da JHSF Participações, que é a nossa empresa brasileira. Foi um spin-off ocorrido em 2016, onde a gente separou em uma empresa fora do Brasil os ativos internacionais. Esse foi um movimento que a gente começou há 10 anos atrás, mais ou menos, com investimentos basicamente no que a gente chama de tijolos, né? A gente não tinha nessa empresa lá no início nenhum investimento de fundo, nenhum investimento financeiro. E foram investimentos que foram bem sucedidos. A gente teve 2 negócios em Nova York. Um é o Fasano, que é o prédio na Quinta Avenida que a gente vai estar inaugurando agora em dezembro. Fizemos também a compra e venda de um outro prédio na Rua 57, foi um negócio que foi bem. e também o investimento nosso lá no Uruguai, em Punta del Este, nesses 10 anos. E um pouco juntando a história toda que o Pedro contou e um pouco com a nossa visão, é que, no fim, esse assunto de investir em imóvel fora do país, em tijolo, é uma estratégia boa, e eu acho que a gente, como JHSF Internacional, pôde fazer isso, implementar, mas ela é sempre uma estratégia de ciclos muito longos. Então, você pegar o nosso projeto de Punta del Este, para entrar em break-even foram 7, 8 anos, o nosso prédio na Quinta Avenida, lá em Nova York, foram 8 ou 9 anos até ser inaugurado. Esse outro empreendimento que nós compramos e vendemos demorou um ciclo de, no mínimo, 3 anos. Foi um pouco mais rápido, mas também deu uma sorte ali de mercado. Mas, basicamente, são processos longos, que você passa por processo, você passa por aprovação, você passa por toda o desenvolvimento de um projeto, né? E a gente viu que o mercado hoje, e até para a estratégia de JHSF um pouco mais de longo prazo, da JHSF Internacional, a gente viu que a gente não queria estar só baseado nesses investimentos de ciclos muito longos e que tinham classes de ativos que estavam sendo aí também emergentes no mercado e que dentro do mercado americano é uma estrutura realmente muito grande, muito profissional desses REITs, estava acontecendo e que a gente, como JHSF, deveria estar um pouco mais atento que isso. Porque, no fundo, se você procura ciclos mais curtos, né, ou uma flexibilidade maior de entrada e de saída, ou fazer investimentos que eles estão todos os dias marcados a mercado, né, que acho que é a característica principal dos REITs, quer dizer, você sabe exatamente o que está acontecendo com o teu investimento todos os dias. Os REITs são classes de ativos imbatíveis. A gente, a partir disso, começou a pesquisar um pouco, chegamos a fazer alguns investimentos na JHSF Internacional em REITs específicos, mas a gente sentia que faltava uma análise e uma capacidade de análise profissional para a gente poder tentar entender esse mercado de uma maneira mais organizada e até com uma visão de mais longo prazo. Foi aí que o Pedro, quando trouxe o assunto da possibilidade da gente ficar sócio da JLP, eu falei, poxa, Pedro, isso aí acho que é muito bom, porque para a gente esses ativos hoje eles são uma maneira mais moderna de investir, porque a gente vê, eu vejo até muitos clientes às vezes me perguntando, falar, pô, eu quero ir para Nova York, eu quero comprar um apartamento, quero vender um apartamento, e essa estratégia de comprar o tijolo, que a gente chama de comprar o ativo imobiliário em si, ela ficou uma estratégia mais difícil, ela é mais, tem o condomínio, tem o IPTU, tem a taxa que tem que pagar de imposto que está cada vez mais alta, quer dizer, então não é muito fácil mais hoje em dia entrar e sair ganhando dinheiro de ativo tijolo, né? E a gente achou que essa possibilidade de conhecer mais a fundo os REITs é uma maneira mais moderna de investir com mais flexibilidade, mais clareza do valor de mercado. E por isso aceitamos o convite rapidamente do Pedro e do Edu. Por coincidência, eu conhecia já o de longa data, porque ele tinha analisado há um tempo atrás o investimento em JHSF do Brasil, então eu pude participar e presenciar o nível de diligência e de profissionalismo que a equipe do Jim, ele, o Ivo, a Amanda, a Suen, tiveram com relação à nossa empresa. Realmente eles sabiam coisas que muito poucos analistas ou empresas sabiam da gente. Então, a hora que foi introduzido que a equipe que lidera a JLP, né, a ex-Jaguar, era o Jim, eu fiquei ainda mais tranquilo e pude dar um testemunho pessoal da capacidade que eles têm realmente de fazer um trabalho muito bom. Então, acho que a plataforma está aí e eu vou passar a palavra para o Jim, para ele contar um pouco mais aqui da sequência do investimento para vocês. Muito obrigado a todos. Jim.
Great. Well, thank you. Jose, thanks for those nice comments. What I'm going to do is I'm going to first hand this off to Amanda to describe the overall market, the market opportunity set, and where we see the market environment today. Then I'll give you, and also the dispersion we see today, because it's been wider than we've seen. And as Eduardo mentioned, we've seen some things valuation-wise that are as intriguing as they were in 08, 09 in the financial crisis. I'll give you some background about the firm and our history, as well as the investment approach and process, which Jose saw up close and personal when we spent a couple of years digging deeply into his business, and then give you some more information about the fund itself, and follow that with examples of actual investments based on our investment process, so you really can see how we operate and get a good, clear sense of that. So with that, I'd like to hand the ball off to Amanda to give a view about where we are today in the markets, and also, again, the wide range of opportunities, as Pedro mentioned, all different property types and all different markets, and our experience of 20, 30 years of doing this, we have been in pretty much every market. So Amanda, take it away.
Good evening, everyone. My name is Amanda Black, and I lead the firm's investments in North America. I'm very pleased to meet you all and to get the chance to build an investment case for our product and strategy tonight. Very quickly, some background on me. I've invested in listed real estate for my entire 20+ year career. I've done so across all types of strategies, and that includes dedicated, long-only hedge funds, large bank prop desks, and general equities funds. And believe it or not, I've worked with this crew 2 separate times in my career, and probably have spent about half of it with them. So let me dive right in and explain to you the very exciting opportunity that we see right now to invest in real estate equity securities, which is what we specialize in, and have designed a very exciting fund strategy around. So first, just to give you the lay of the land, and I'm on page 8 of the slide deck. The public real estate markets are huge, and you've heard this already be alluded to. We estimate that approximately 15% of all global real estate is held this way. We think the market cap of globally listed real estate companies is around 4.5 trillion, and it includes hundreds of investable companies. You can see from the pie chart below where those companies are located. The lion's share of market cap is in the big developed nations you'd expect, the US, Hong Kong, Japan, UK, and Europe, but we estimate you can access the real estate markets in around 50 countries globally. Even more exciting are the property types available for investment this way. You can see that on slide 9. Many of these property types you cannot easily access any other way than through the public markets. There are public real estate companies that specialize in all forms of residential, including single-family homes for rent, apartments, manufactured home parks, student housing, home builders, and so on. All forms of retail, including malls, grocery-anchored shopping centers, which offer your daily goods and services to local communities, and standalone retail, such as gas stations and even your local McDonald's franchise. Office properties, which you guys will all be very well acquainted with, industrial and logistics properties, hotels, healthcare facilities, self-storage, and exciting new sectors that have also been referenced earlier on, such as the data centers and the cell towers. And just to give you a few examples of companies that you've probably heard of that are within our opportunity set, I would highlight Marriott Hotels and Hilton Hotels, 2 of the largest global lodging companies in the world, and maybe even large office property owners in New York City, which might include Boston Properties, Vornado, SL Green. And you can see many of the examples listed here on our slide. Hopefully some of those are names that you recognize, but the main takeaway is that this is a very large, dynamic, uncorrelated asset class that offers significant opportunities to take very specific, targeted, investment bets and for real estate specialists to generate investment returns from. So let me walk you through what we think the advantages are to investing in real estate through the public companies as opposed to through other vehicles. These vehicles, unlike private funds, they're infinite life vehicles. So for that reason, they grow very large, and they've been able to accumulate and to hold on to some of the very best assets in the world. These portfolios truly are unmatched. The best management teams, obviously there are good managers and bad in all spaces, but this sector, because of its size and the assets that it controls, it clearly attracts some of the best and the brightest out there. The asset class itself has predictable, solid earnings growth. People may not realize this, but even during the global financial crisis, real estate top lines drew down less than 10%. So positive, solid, predictable growth. Low leverage is another major factor in favor of this asset class right now. The negative headlines that you would have seen so much about during the global financial crisis, those were a result of over leverage. The public companies learned big lessons from that. They not only had to dilute shareholders by issuing unattractive capital to recapitalize themselves, but they also had to sit out and miss all of the amazing opportunities that were created by that crisis. They have not gone into the end of this cycle in that same position. Leverage globally for the public companies is approximately 34% of LTV. This time, they generally will not issue dilutive capital, and they'll be the ones capitalizing on the distress. And it's going to be a big advantage for this space as we move forward. Strong corporate governance, it may sound boring, but I think it's actually really key here. Generally, these companies are highly aligned with shareholders, and even more, currently, the discounted valuations where they're trading and the rise of shareholder activism have put them in positions where they must grow earnings and they must do the right things in terms of realizing value, or they risk losing their companies and their jobs. And that creates a pretty serious alignment of interest that we like. And then finally, they have a cost of capital advantage. The public debt and equity markets are currently wide open and offering some of the cheapest capital in the world. And these companies have what appears to be unlimited access to that right now. And that's another big advantage that they're going to put to work through the end of this cycle. And it's not just the companies themselves that are attractive in this space. There's also structural advantages that are worth highlighting to investing in real estate this way. Liquidity and volatility are two that I would bring up. We have very good liquidity, and that means we can easily rotate capital in and out of companies, sectors, and countries. That enhances our returns and it reduces our risk. One example I'd give you for that is cold storage. Cold storage is an industry that is currently experiencing accretive consolidation trends and very strong secular demand trends. You want to be exposed to it. However, over the long term, say a 7-year private equity fund hold period, you may not want your capital locked in cold storage, which is not always a great business. Cold storage is heavily reliant on labor, and they own very highly CapEx assets with no alternative use, and assets which are depreciating, which isn't true for a lot of real estate sectors. So it's a perfect example of when you'd prefer to expose your capital such that you could easily get in and out via the public markets rather than make a long-term commitment. And then I also brought up volatility. This is a factor that a lot of people actually complain about. It's exactly what creates the constant opportunities that we can exploit to generate alpha. And already this year, you've seen the market take a few dramatic dives, and you could sharpshoot investments then, and that didn't happen in the private markets. Those opportunities were not available there. So the volatility is actually your friend in terms of enhancing returns anyway. The public markets offer you the ability, as we stated before, also to invest in alternative property types and countries that aren't easily accessed other ways, or where private investments are clearly not the best alternative. Examples of this would include our ability to invest in emerging markets such as Indonesia, India, Malaysia, and in terms of property types, where the public companies are the clear dominant players and you prefer to invest alongside them as opposed to smaller private players. Cold storage is another example of that. Americold, whom we invest with, is absolutely the dominant best player in the US right now, and we'd rather invest alongside them with their ability to accretively use their public capital to roll up assets and where they have leverage over their clients because of their size. Self-storage is another great example where your Google search ranking and your pricing technology determine whether you're the winner or the loser. The bigger companies are absolutely the winners here. Data centers, where Equinix, a stock that we own, basically owns 50% of the world's internet exchanges. They own the internet infrastructure. You can't get that through the private markets. So those are sectors that you can only access via the public markets or where you're better served to access through the public markets. And finally, I'll leave you with this on public real estate. The historical returns, as you can see on the slide 10 in front of you, they're phenomenal and they're consistent. The 20-year return is 10% for US listed real estate and 8% for global, and that leads most other asset classes. Now to get to the good part, what's really most important right now, why is this a great opportunity right now? All of what I described are reasons that real estate accessed through the public markets is always a great investment, but today's setup presents a particularly compelling entry point. And if you look on the slide 11, COVID has hit public real estate company share prices particularly hard. Global shares are down 11% on average this year, and at the lows, we were down 40%. And that 11% number, it's very skewed by a few large sectors that have done exceptionally well. The distressed pricing in other categories is actually larger than that number might imply. If you compare this to the broader markets, which are up 10 to 15% this year, it looks particularly beat up for us. Public markets always price in a recession earlier than private markets, and they also recover sooner. You've seen the public markets price in the downside, and we believe we've already started the recovery. That process has not begun at all in the private markets. That said, we aren't even convinced that the private markets are going to price it in or should price it in. While the top lines are going to suffer temporarily from the recession, interest rates have now hit a new all-time low globally. There's more private equity capital on the sidelines designated to buy real estate than ever before in history. We actually believe that valuations are set to rise, and all the evidence we're getting from the market so far in 2020 supports this. Valuations are rising. Current share prices reflect a fall in values that isn't coming. These companies are attractive on both a relative and nominal basis to other real estate investments and to the broader markets. And if you'll look at slide 12, this slide will highlight for you the very wide disconnect between stock prices and intrinsic values. And I'm going to let Ivo and Swaneng walk you through some company examples, but just very quickly to give you an example of what this slide should mean to you. Boston Properties is the blue chip premier landlord for office in the United States. They own the General Motors building in New York. They own Salesforce Tower in San Francisco, for example. They're trading at $500 per square foot in the market. We believe that they're worth $1,100 per square foot, or up to 100% upside from here. We can back that up with significant market comps for buildings all around them, buildings that are still trading. The office market is large, it's liquid, and these discounts are real and they shouldn't exist, and we believe that they're set up to be arbitraged away. I think that the recent vaccine news that we've all seen in the markets has been a catalyst to begin to get those gaps closed. Shares of the discounted companies have skyrocketed, and that type of movement attracts all kinds of investors, and I think that we're going to see more and more of that mindset become embedded from here on out. And then just finally, as I've given you the case for beta in this sector, I want to close with highlighting why it's also a particularly great time for a sector specialist to extract alpha from this sector too. On slide 12 there on the right side of the page, you'll see that the increased volatility means that dispersions are elevated. You can see the enormous gap between the top and bottom performers. We're not quite at the global financial crisis levels, but we're very close. And that's exactly when a specialist can pinpoint pricing discrepancies and capitalize on them. And also, as the next slide references, slide 13, the sector has become dominated by passive funds. These funds are big and dumb, and they amplify the volatility and mispricings that are out there. And there's a lot of other factors that we believe have also created inefficiencies in our markets that have increased our ability to generate alpha. Just to name a few: Fed intervention, capital is definitely mispriced. Companies that should fail are not failing. The research business has been hollowed out by trading trends and by MiFID. What used to be a very efficient market with too much research coverage and information is not that any longer. And short-termism. Jim is going to highlight for you why our strategy and fund structure play to this later, but there are many factors out there causing investors to be both short-term thinkers and short-term investors. And this means the stocks with enormous upside, but which may take a bit longer to play out, are being consistently mispriced. And those are exactly our opportunities. So I'm going to wrap up with that, but I just want to reiterate to you, real estate is a fantastic asset class that is offering a particularly compelling investment opportunity right now. And the setup for alpha and beta generation are excellent. So let me hand it off to Jim to tell you why our team and investment strategy is set up to capitalize on that opportunity.
All right, Amanda, thank you. And I hate to have a break in all the excitement about the great opportunity, but I'll give you a little bit more background about the firm and how we got here, just so you guys have a sense of that. You've heard about the history. You've heard also we've got, I think, a number of offices in Amsterdam, Singapore, and now I guess we can throw in São Paulo. And having that local presence is really important, and having a team that's really experienced in the real estate business. And I think one of the key things that I discovered years ago is that those of us who have real estate experience on the ground, both in development and management and in all different property types, have a distinct advantage over those investors looking at these just as a pure stock form of investment. And so when we set up the business years ago, a couple things that I thought were really important is that we should be concentrated in our stock picks and really focused on these companies and have high conviction. And so we really weren't focused on the benchmark. And back then, and if we look back in 2000, almost everybody there were closet indexers and tracking the benchmarks, whereas we were really just trying to find good value in the markets. And so we built up a portfolio, and over the years got it up to about $14 billion. And one of the things we learned when we got that big is that the kinds of companies that got us there tended to be the smaller cap companies that grew, tended to be the kinds of companies where we spent a lot of time with management. And it kept us out of investing with great companies like JHSF because we were just too big. So we wanted to get back to our roots. We were with a company that was owned by a German family, and they wanted to double or triple the AUM and become more of a benchmark manager. So in 2014, the team said, let's go back to what we know we like to do and we think we can do well. And I can tell you, in a more concentrated, high conviction strategy, 14 billion was too much. And we joined up with Northwood Securities, which is founded by an old friend of mine who had really founded, was one of the original partners at Blackstone. The concept there was get even deeper into the real estate side of it and hopefully take advantage of greater arbitrage opportunities. They saw over time, they saw that our business was also one they wanted to get into. And we started competing both for investment opportunities as well as fun as investors. So we agreed, and we with John Kukral, who founded Northwood, to buy him out or buy the company away from him, together with Singaporean families who Eduardo mentioned or Pedro mentioned earlier, and then form JLP and complement that with our investors in Brazil, which we're real excited about, and giving us a window into markets that we really have not seen before. We've been in to look at all the companies in Brazil and LATAM, and I know Ivo spent a ton of time there. But really, this opens up a great opportunity. And then also rounding out the board with Ellen Schumann's participation, who's someone I've respected for decades, and we're really looking forward to taking this company to another level. and rebuilding. So with that, next slide. Now, another interesting element that's, I know you guys have been reading about a lot, and it's become front and center for many investors these days, is ESG. Now, just so you know, we've always focused on governance because most of the companies that we invest in worldwide were formed by families, and you have all kinds of governance issues that result from that. So we've always been focused on that, but the E and the S have not been necessarily something we have paid attention to. Joris Janssen used to be with us earlier on and then joined PGGM, which is, if you're familiar, it's a large pension fund in the Netherlands that focuses on health and welfare services employees, and is very, very focused on ESG. So he's added a new dimension to our ESG focus. We've developed a proprietary ranking system, and we're all excited about our ability to implement that in our analysis of the companies. And one of the key things that we want to be sure is that we're doing this right. And it's not just, as I've been reading about lately, greenwashing, that you just do it optically, but we really are incorporating this in the investment process. So let's talk a little bit more about why JLP and what we're all about. We have always defined ourselves as very active managers. And I guess from my perspective, if I'm looking at it on your side of the table, if you want an active manager, you want to be sure they are truly active. And we look at that the same way in the case of the companies. We are investing in companies that we like to say they're rent growers, they're builders of value, not just sitting back and waiting for the rent check to clear. That takes a lot more analysis from our side. And we really do get deep into the weeds with our companies and reviewing them in all aspects. So it's trying to find who are the better managers and operators in a given market. And frankly, you can get that if you take the time to do it. But as we have been seeing over the last decade, analysts have shortened up their time horizons and haven't really been digging as deep over time. And we find that if you talk to the companies themselves, very few are getting as deeply into the company's backgrounds as I know Jose found when Ivo spent untold hours asking them millions of questions to get everything he could possibly get out of them. And at the end of the day, we feel like we get to know the companies almost as well as management. So that's a very important part of our business, and developing relationships with those company senior execs, we think helps in generating an informational arbitrage opportunity for us as well. Again, it's high conviction and it's also concentrated. As I'm sure you well know, when you get up to more than 50 stocks in a portfolio, the marginal benefit declines pretty quickly. Now, one of the questions I'm always asked is how can you keep an eye on world markets with a relatively small team, but remember all of us have had lots of experience in the business, and we also use sort of a triage approach. So where we see great value opportunities, great investment opportunities, we dive in and hit it hard. And if markets are oversupplied, overvalued, and we don't see much interest or political instability, as we found when we got excited about Turkey and that kind of went to hell quickly, we'll just monitor it. Again, though, it's having this experience of being in these markets over all these years where we know where the good places are that we want to be and where we want to avoid. We have learned the hard way that we really want to invest in quality managers. This is a big asset, big lumpy asset. When it goes bad in a hurry. And what we found is great managers will get you through the tough times, and bad managers can ruin the best real estate. So that's a major underwriting focus for us, and making sure that we do all the investigation that we can to ensure that we've got the right management team is critical. when we're investing in these companies or looking at investing, I should say, where the analysts and the PMs are all involved. And the philosophy there is we want everybody to have an ownership stake in the investment, not just that the analysts throw an idea out and the PM picks it up or doesn't. Everybody's intimately involved with the decision-making process. And then if we like a company, we don't really want to see anything below 2%. It doesn't really make sense to hold it. And then if it's a great company, it can get as high as 8%. And then we have a number of risk parameters that are set up depending on the fund and the client. We are monitoring these companies continuously, and both from a technical perspective as well as fundamental perspective. So each analyst is staying on top of the company's developments and tracking the price. And we've got very firm price targets, which will get adjusted if we learn new information. But otherwise, it'll be that's it. If we hit the price target and get within 5%, we start thinking about selling it. Now, as you can all imagine, whenever you're looking at companies, they don't always go up. And we've had plenty of cases where they don't. And if they're going down more than the market, then we'll re-underwrite them effectively because maybe there's something we missed. With that, I will pass the baton off to Ivo to give you a review of VGP.
All right, thanks, Jim. Good evening, everyone. My name is Ivo Timmermans. I manage the Amsterdam office, and I'm responsible, together with my team here, with 2 other analysts, for our investments in Europe and emerging markets outside of Asia. And I was also responsible for conducting the due diligence on JHSF Participações that José Oriemo and Jim already alluded to earlier in the presentation. So what I will be doing, I'm going to walk you through our European investment case, which is VGP, which has been, and we believe will continue to be, a very attractive investment opportunity. VGP is a pan-European family-run logistics developer and operator, currently present and operating in 12 European countries with a prime focus on Germany. The company has a total asset base of 2.2 billion euros, and that's proportionally consolidated and based on a very conservative valuation yield of 5.8%, whilst current transaction evidence in Germany is actually materializing at 3.5%. So you see that those valuations are pretty conservative. The company's market cap is 2.5 billion euros, and the LTV of the company is currently 35%. LTV is measured by basically dividing interest-bearing liabilities over real assets. One of the main reasons why we're in this stock, why we're invested in VGP, is because we believe it has a unique business model where it sells 50% stakes of all its developments into one of its 3 JVs it has with Allianz. And this provides 3 immediate benefits. The first benefit is it provides liquidity at all times, even in uncertain times like we're currently living through. It also assures that those significant development profits that are being generated are immediately redeployed into new projects. And thirdly, it provides the company with an additional source of income because VGP manages the assets on behalf of the joint venture. And by doing so, it actually gets a 1% management fee as well as a performance fee after year 10. Then when we look at future growth, the company is currently present, as I already mentioned, in 12 countries, but it's not present in France and the entire Scandinavian market. For example, Sweden and Denmark are markets that management is currently looking at. And we know from the company, we're actively engaging with the company on a very regular basis, that we believe that certain deals will be closed over the next couple of months, which should serve as a catalyst for this stock. It's important to bear in mind that acquiring land in these countries comes on top of VGP's already large land bank, which currently stands over 3 million square meter of lettable area, and that's 1.5 times its current GLA in operation. Important to bear in mind and important to mention also is portfolio performance during this pandemic. What we've seen is that hotels and retail actually suffered quite a bit during this pandemic, with occupancy rates dropping, collection rates dropping in some quarters to below 50%. But VGP basically was not affected. The occupancy rates are still 100%, and collection rates are still very much in line with pre-pandemic averages of 99 to 100%. So there is no impact of the pandemic at all. Lastly, and is also a very important point to make, is that we believe that the shift to online retail and the growth of e-commerce will continue going forward, and will probably accelerate. And another thing is that what we're seeing here in Europe as a result of the pandemic is that a lot of companies are actually reshoring or onshoring a lot of production and manufacturing activity from Asia, mainly China, back to the European mainland, because during the pandemic, what happened was that a lot of countries were actually caught off guard, where a lot of medical devices and face masks were not available. Then lastly, and obviously this is a critical point when we make an investment, is valuations. VGP shares were up more than 50% last year. They're already up 30% year to date, but we continue to see upside. Shares are currently trading at 120 euros. And we believe that the fair value is 140 euros at least, but we can easily upgrade that to 150 to 160 because our estimates are quite conservative. As Jim already mentioned, we don't only invest based on value. I think catalyst events are critical. And in spite of the good performance, obviously should normally raise some eyebrows, but we believe that there are significant catalyst events to come over the next couple of months and years. One of them would be to upscale existing JVs with Allianz. A second one would be getting into new joint ventures with either Allianz or other JV partners. A third option would be what I already alluded to earlier, entering new countries like France or Scandinavia. But I think the biggest catalyst would be the possible sale of the entire business to a larger logistics platform or institutional capital. And what we have seen is that M&A activity in general has been a key driver for shareholder returns in some of our investment cases. For example, Simon Property Group, they made a bid for Taubman in the beginning of the year. And very recently, a few weeks ago, Wellcome Trust, they made a bid for Urban and Civic. And in both cases, we were shareholders in Taubman and in Urban Civic, and we sold out after the bid was made. I think it's important that, unless markets recover to pre-COVID levels, and currently we are far cry away from that, we believe that public to private activity will remain a key theme. Private equity funds here in Europe and the US in particular have tons of dry powder that needs to be invested. And most companies also have very easy access to credit, which bodes well for M&A activity. And I think another key thing is that in a world where it's very hard to find yield because the entire sovereign bond market here in Europe is basically trading in negative territory, I think real estate looks very attractive, especially an asset class like logistics. And with that, unless there are any immediate questions, I will hand it over to Swaneng.
Hi, Ivo, thanks. Hi, I'm Swaneng. I sit in Singapore, and together with my 3 other colleagues, we look at Asia. We have about 15 countries with listed real estate securities in Asia. The company we want to feature from Asia is Hang Lung Property. Hang Lung Property is a $12 billion US market cap, property company listed on the Hong Kong Stock Exchange. Hang Lung has a very strong track record of operating malls in China. At this moment, they own 9 completed malls in China in 7 cities, and also a pipeline for completion in the over the medium term. The malls are different from the other malls in China in that, number one, the mall typically occupy the best location in the city due to the first mover advantage. Hang Lung entered the China market much earlier than their peer, and they negotiated directly with the local government to secure their site. They were welcomed with open arms by the local government because shopping malls provide the local with lots of employment opportunity, and more importantly, a successful mall pay a lot of taxes. In many cases, they were actually invited by the local government to come in, and because of their bargaining power, they were able to get the best spot in the city for a very good price for the land as well. The other differentiation from the other mall is that the malls are managed by a Hong Kong company that has years of track record of managing mall in Hong Kong. And Hong Kong is actually a shopping heaven in Asia. So the mall typically become a landmark in the city with all the luxury brands housed under one roof, and probably a wait list for others who are not there but want a spot there. So even during the difficult year in 2014, 2015, when the central government clamped down on corruption and gifting, and a lot of luxury brands had to downsize because they had expanded too aggressively earlier. And what happened was that all these brands closed their outlets in other locations and consolidated the operation in Hang Lung Mall, because to them, China is a very important market long-term, and they need to maintain a presence in the city. And they choose Hang Lung Mall because they know that it's the best location in the city. Nonetheless, despite the good occupancy, the retail sales suffered because of the government clamping down, and also past 2 years, because of the Trump presidency, there was a lot of trade tension between China and US that impacted the equity market sentiment in China, which has an impact on on retail sales as well. And this year we got COVID-19, and the mall had to close as well. So the mall had gone through a very difficult period. But starting from the second half this year, we are seeing very strong rebound in retail sales in China, partly because the pandemic is brought under control, partly because the Chinese cannot travel and they can't shop overseas anymore due to border closure. If you look at the retail sales in the second half, they actually grew by 30 to 50% year on year. With this recovery in retail sales, and also the low base due to many issues in the past, we think Hang Lung earning is set for multiple year expansion for the next few years. Also because they have new mall completing as well. Sentiment-wise, retail names has been one of the most impacted globally from the pandemic. And I think reverse is going to be true when a vaccine is eventually found. Also, there's a minor tailwind of the new presidency in US. We hope that with the new president in the US, that will lead to more cooperation between US and China, or maybe less tension between the two countries, and that should be a minor tailwind for companies having operation in China. Valuation-wise, the stock is at a 30% discount to asset value. We bought the stock earlier this year and has gone up a little bit. But in my opinion, Hang Lung gives the best exposure to the best shopping mall in China. The malls are actually worth a lot of money because you just cannot replicate the mall anymore because of the location. Dividend yield-wise is about 4%. That is sustainable. And if you compare to the local interest rates of which is very low at this moment, 4% is something very, very attractive to investor. And this dividend is sustainable because earnings are set for multi-year expansion. We think when the pandemic is brought under control, when the vaccine is found, easily the stock can rebound another 20-30% from the current level.
Queria muito agradecer aqui a presença de todos e encerrar aqui a noite com muito boa noite aí para todos vocês.